Have you ever seen a stock just take off? What happens when a single government contract sends a company's stock into the stratosphere? Well, that's exactly what just happened with Netweb Technologies. Today, we're going to decode the massive surge behind this Indian tech player. So, just recently, Netweb's stock didn't just climb. No, it absolutely shattered its all-time high. And a surge like that always has a story behind it. And trust me, that story is a big one. We're not just talking about good earnings here. It's tied directly to India's massive ambition to build its own powerful sovereign AI infrastructure. A huge deal. So that brings us to the big question, right? Is this incredible, meteoric rise actually built on a solid foundation, or is it just a bubble of hype? Well, let's dig in and find out. Okay, so first things first, we need to understand what lit the fuse here. What was the catalyst? Because there was one specific piece of news that really sent this stock soaring. And this is the number that lit that fuse. 1,700 crore rupees. I mean, just think about that figure. A number so massive, it's a clear signal, it's a huge vote of confidence from the absolute highest level. Now, look, this isn't just any old contract. The Indian government has literally tasked Netweb with building the hardware for a national AI system. And why are they doing this? Well, the goal is pretty clear: to cut down India's reliance on the big US tech giants, like Amazon's AWS and Google Cloud. This isn't just a business deal. It's a project of national importance. So who is this company that's been chosen for such a crucial national project? What does Netweb Technologies actually do? Let's break it down. Okay, so their core business is building what most of us would just call supercomputers. And these are not your desktop PCs, not by a long shot. We're talking about incredibly powerful systems built for governments, universities, and massive corporations, the kinds of places that need to run super complex simulations and crunch just vast amounts of data. Then their second major area is something called hyper-converged infrastructure, or HCI. Now, the simplest way to wrap your head around this is to think of Netweb building a complete private cloud for a client. They literally handle everything: all the computing, the storage, the networking, all bundled up into one integrated system. And this right here, this is their secret sauce. It's their key advantage, what investors call a competitive moat. Netweb is an Indian original equipment manufacturer, or OEM. So what does that mean? Well, unlike competitors who might just assemble parts from other places, Netweb designs and builds its systems from the ground up right here in India. And that status, that's exactly why they get priority for these critical government and defense contracts. Okay, so a great story is one thing, but you and I both know the numbers have to back it up, right? So let's take a look at where their money is actually coming from, and more importantly, how fast they're growing. All right, so if we look at their revenue mix, you can see it's a pretty nicely diversified business. You've got high-performance computing and that hyper-converged infrastructure we talked about. They're the two main pillars, each bringing in about 35% of the revenue. And here's what's so crucial for the future. AI systems already make up a pretty significant 15%. That's a big deal. Okay, now this is where the growth story gets really exciting. I mean, just look at these numbers. Their core HPC business has grown at a really impressive 57% annually. That's great, but look at their newer ventures. HCI is growing at a staggering 103% a year, and AI systems are right behind at 91%. This is the rocket fuel for the company's future. Explosive growth like this can sometimes come with big risks and a mountain of debt. So let's pop the hood and see how financially healthy Netweb really is. And honestly, the financial picture here is very, very strong. We're seeing consistent growth in both sales and profits year after year. The founders, or promoters as they're often called in India, they still own a massive 75% stake. That shows they have serious skin in the game. And on top of that, you've got major institutional investors. We're talking the big, smart money funds who've also bought in. And that, my friends, is a huge vote of confidence. And maybe the most impressive number of them all? This one. The company is practically debt-free. It has a tiny debt-to-equity ratio of just 1.3%. What that means is they're funding all this incredible growth entirely on their own steam, not by taking on a bunch of risky loans. That's amazing. So we have a great story, a strong business, and rock-solid financials. But all of this brings us to the toughest question of all. What is all of that actually worth? And this, folks, is the valuation debate. So, the stock's price to earnings ratio, or PE, is sitting at 136. Now, in simple terms, that's just a measure of how expensive the stock is compared to its current profits. And let me tell you, 136 is extremely high. It tells us that investors are betting, and betting big, on massive future growth. So, is it just too expensive? Well, like with any good debate, there are two sides to this. The bulls, the optimists, they'll point to forecasts of 40% annual earnings growth. They'll talk about the massive government support for AI and how Netweb's in-house R&D gives them pricing power. But the bears, the pessimists, they're worried about the stock's volatility. They see a risk that this kind of tech could become a low-margin commodity, and they're concerned about the company's reliance on these big, one-off government deals. Okay, let's try a quick thought experiment, just to see if that high price could still be a good investment. Ready? First, let's assume profits grow at a strong, but maybe a little more conservative, 30% per year for the next 5 years, okay? Second, let's say that after those 5 years, the market values the stock at a more normal or fair PE ratio of, say, 50. So what does that imply? Well, the calculations suggest that even starting at today's super high price, an investor could potentially see an annual return of around 11%. It's a really powerful example of how explosive growth can sometimes justify a high valuation. All right, so we've decoded the past, we've analyzed the present. Now let's look ahead. What's next on the road for Netweb? Well, the best news for investors is that the future isn't a complete mystery. Between their existing order book and that massive AI infrastructure project we talked about, the company has a very clear runway for growth for at least the next 18 to 24 months. That's some serious visibility. So, let's boil this all down. What are the key takeaways you should remember? First, Netweb has a powerful competitive advantage, that Indian OEM status we discussed. Second, its financial health is rock solid. It's virtually debt-free. Third, it has a clear growth path for the next couple of years. And the single biggest risk? It all comes back to the valuation. The company is basically priced for perfection, and it has to keep delivering incredible growth to justify that price tag. And that really leaves us with a final, fascinating question to think about. Netweb isn't just selling computer hardware, right? They're a key partner in building a whole nation's technological future. So the real challenge for any investor is this: how on earth do you put a price tag on that kind of ambition today?